If you could invest in an account that gives you a tax deduction going in, grows tax-free while you let it sit, and then allows you to spend that money tax-free later in life, you'd probably call that the perfect retirement account. Well, it actually exists. It's called a health savings account, or HSA. Most people think of an HSA as a simple way to pay for doctor visits or prescriptions, but if you use it correctly, it can be one of the most powerful tax-free wealth building tools in your entire financial arsenal. Today, I'm going to break down exactly who qualifies for an HSA, how it works, what the limits are, and how to turn it into your very own secret Roth IRA. Now, not everyone can open or contribute to a health savings account. To be eligible, you have to be enrolled in what's called a high deductible health plan, or HDHP. That means your health insurance must meet certain minimum deductibles and maximum out-of-pocket limits set by the IRS. For 2025, that means your deductible must be at least $1,650 if you're on an individual plan, or $3,300 for a family plan. And your maximum out-of-pocket expenses can't exceed $8,300 for individuals, or $16,600 for families. If your plan meets those thresholds, you are officially HSA eligible. There are a few other conditions too. You can't be covered by any other non-HDHP insurance. You can't be enrolled in Medicare, and you can't be claimed as a dependent on someone else's tax return. If you check all those boxes, congratulations, you're eligible for one of the best triple tax advantage accounts in America. Here's why the HSA is so special. It's one of the only accounts that gives you 3 layers of tax benefits. Tax deduction on the front end. Every dollar you contribute lowers your taxable income that year. Tax-free growth while it's invested. You can invest your HSA funds in mutual funds or ETFs. And any interest, dividends, or capital gains grow completely tax-free. Tax-free withdrawals. As long as you use the money for qualified medical expenses, you'll never pay a dime in taxes ever. The only other account that comes close to this is when you use your standard deduction to offset distributions from your IRA or 401k in retirement. Not even a Roth IRA can reproduce this kind of magic. The Roth gives you tax-free growth and withdrawals, but no deduction on the way in. The HSA gives you all 3. So how much can you put into an HSA each year? In 2025, the limits are $4,300 if you have self-only coverage, and $8,550 if you have family coverage. And if you're age 55 or older, you can make an additional $1,000 catch-up contribution per year. That might not sound like much, but remember, the real magic happens when you let that money compound for decades without ever paying taxes on the growth. Most people make the mistake of treating their HSA like a checking account. They contribute, swipe their HSA debit card at the doctor's office, and move on. But that's not how you build wealth. The smart way to use an HSA is to pay for your healthcare expenses out of pocket, using your regular cash flow while leaving your HSA money invested and untouched. Here's why. Every dollar you leave inside your HSA continues to grow tax-free. If you spend it right away, you lose the opportunity for decades of tax-free compounding. So you pay for your medical bills yourself, and then you save those receipts, every single one of them. You can store them digitally or in a physical file. The IRS doesn't care when you reimburse yourself, as long as you can prove that the expense was legitimate and that it occurred after you opened your HSA. Here's where it gets exciting. Let's say you start investing in your HSA in your 30s. You keep contributing each year and you never touch the account. Meanwhile, your medical expenses, dental visits, prescriptions, eye exams, even Band-Aids and first aid kits are paid out of pocket. You keep those receipts in a folder or in the cloud for 20 or 30 years. Fast forward to your 60s. That HSA has had decades to grow and compound tax-free. Now you decide to reimburse yourself for all those past medical expenses, maybe $25,000, $50,000, or even $100,000 worth. You can take that money out completely tax-free because you have the receipts to prove it. You've essentially created a giant tax-free withdrawal at a time in your life when your healthcare expenses are most likely to be the highest. And that's why I like to call the HSA a secret Roth IRA. It's not designed for retirement, but if you use it strategically, that's exactly what it becomes, a tax-free bucket you can tap whenever healthcare costs start to climb in your later years. Let's take a look at an example. Say you contribute $8,000 a year to your family HSA for 30 years and you invest it aggressively, earning an average annual return of 7%. At the end of those 30 years, your HSA could be worth around $760,000, all tax-free. Now imagine you've been paying your out-of-pocket medical bills from cash flow and keeping your receipts. You could withdraw tens or even hundreds of thousands of dollars from that HSA completely tax-free at any time. And after age 65, there's an additional bonus. Even if you use the money for non-medical expenses, you can still withdraw it. You'll just pay regular income tax just like a traditional IRA. So worst case scenario, it turns into an IRA. Best case scenario, it's a fully tax-free health and retirement account rolled into one. As an aside, qualified medical expenses are broader than most people realize. They include doctor visits and hospital bills, prescription medications, dental and vision care, hearing aids, physical therapy, and medical equipment. Even long-term care, insurance premiums, and Medicare premiums in retirement. That means in your 70s and 80s, when your healthcare costs are at their peak, you can use that HSA money to cover those expenses without paying a single penny in taxes. If you're not using an HSA yet, here's your roadmap. Enroll in a high-deductible health plan. Open an HSA with a provider that allows investment options, not just a savings balance. Contribute as much as you can each year, ideally up to the annual limit. Invest the funds for long-term growth. Pay for healthcare costs from your checking account and keep every single receipt. Then let time and compounding do the rest. So here's the bottom line. A health savings account isn't just a place to park money for next year's doctor bills. It's a stealth, tax-free, wealth-building mega fund that's hiding in plain sight. Used wisely, your HSA can become one of the most powerful components of your tax-free retirement strategy, right alongside your Roth IRA, your Roth 401k, your Roth conversions, and your tax-free life insurance income streams. It's time to stop thinking of it as a medical account and start seeing it for what it really is, a secret healthcare Roth IRA in disguise. If you need help creating a balanced, comprehensive approach to tax-free retirement, head over to DaveMcKnight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Powers Zero network that has been trained, vetted, and qualified personally by me. And if you found value in this video, don't forget to like, subscribe, and hit that bell so you never miss another one. This is David McKnight. Thanks for watching, and I'll see you on the next video.